Hello, and welcome you to today's Trading Spotlight webinar today on Friday, the 3rd of April, 2020. Yeah, it's Friday, and I'm happy to be here together with you again today with a very, very interesting topic. Advanced price action strategies combining different trading timeframes. So it's a quite long title, in fact, but I think a very, very crucial topic when it comes to understand price action in the markets. And in fact, today we want to look at not really real charts, but we will look at examples of how these charts should look like in the real world. So we purely look at theoretical charts. There's one problem with that, because there's from time to time people who criticize this and say, well, now this is purely theoretical. Does it really occur the way you describe it in the real world? To answer this question, yes, it does occur. I want to nevertheless give an explanation why we want to use these theoretical pictures instead of real charts, because I think it's crucial to understand what's happening in the background there. And once you grasp this concept, it will become quite easy to adopt this theoretical knowledge into the real world and really understand also, or grasp at some extent right from the start. You don't even need to be an expert on this. What's going on there? You start to completely look at a chart from a complete different angle in the future. So yeah, this is in fact the reason why we want to look at these theoretical charts. So let's go through the agenda first here, and then we take it from there. So today, first of all, I'd like to give you an introduction to trends, to progressions, and to regressions. We will define this in a few minutes. And we will use this basic concept then to introduce zones of accumulation and of distribution. So to really get an idea of why certain areas are considered to be more attractive, especially from bigger trading participants and institutional players here than others, especially when it comes to risk reward. And then what we will do is we will use this knowledge and look at different timeframes and how to use it to effectively reduce mistrades, respectively fade them, and try also to avoid so-called interrupters in the chart, which are happening quite often right now. That has mainly to do with high frequency trading becoming a big, or is in fact a big part of the price action every day. And you can use this knowledge then, even if you do not plan to trade based on the price action or based from a price action perspective. You can use this knowledge then still also to optimize to some extent your, let's say, automated trading. So we will in fact use this as a potential guideline. So if you had a look at our Trading Spotlight community, for example, you've seen that there's from time to time, or not from time to time, but every day, in fact, there is my setup based on the open range in the DAX and also in the S&P 500. And in fact, this is 100% automated. So there's no real room for discretionary interventions. But at the end of the day, trading comes down to optimize the expected value, respectively, to smoothen the equity curve. And this knowledge, which I present to you today here, can be used, in fact, also to optimize your automated trading strategies. For example, by saying, if we trade in a region of a potential distribution within a price action, or from a price action perspective, that's probably then if we trade in direction of the trend, if the signal is generated here, to reduce the position size, since the risk reward is becoming less attractive. And the other way around, if we trade in a region of accumulation, for example, that's probably it's a worthwhile, or it's attractive to increase the position size, since we are now, once we trade with the momentum here, to increase the position size, since we have the advantage on our side, and probably also from a higher time frame which is dominating us. So that's Today's agenda. Before we start, a quick introduction, not in regards to my person. So if you're interested, if you watch this video now on YouTube, then it's especially easy because you can scroll down, go to the description box, and there you will find a link to an interview I did together with Admiral last year already, and there you get already an idea of where I come from, why do I trade, what do I trade, my experiences in the past and everything. What's probably the most interesting thing is I'm German based, and I'm living where I live in Berlin, the capital of Germany, and that's especially noteworthy because Admiral Markets, the broker here behind this Trading Spotlight webinar series, also has an office here in Berlin in Germany. It's not the only office, in fact, but they have offices around the globe, more than 20 offices, in fact. And why is this noteworthy? Because it means that there's a very, very high chance that you will find someone in the support in support, client support, once you open an account with Admiral, who is talking your respective language, who's speaking your native language, which is in fact based on my personal experiences working in a bank, working also for a broker, not in sales, but having close contact with guys in sales, which is crucial because this builds trust right from the start, because financial questions are usually very sensitive questions, and you really like to talk to someone who speaks your native language. In our case now, it's an English-speaking webinar, so this is not an issue, but I've also seen people here, for example, from Italy right now. It would be nice to have someone speaking Italian, for example. And so this is definitely something which is a big, big plus when it comes to Admiral Markets as a global player in the CFD and FX trading world. As a financial service provider. In addition to that, commissions are very, very attractive. When it comes to DAX trading, when it comes to FX trading, I highly recommend giving Admiral a deeper look, even in the current very tense market environment with very choppy, but also very, very strong, sometimes very dynamic moves with spreads widening and everything. Admiral is really top notch because in my Admiral account, my live account, I don't have any issues when it comes to order execution speed, order execution speed when it comes to slippage. And so this is, I mean, you can run this from a marketing perspective, right? You can always say, oh, look here, I am such a great broker because I have tight spreads, I have low commissions and everything. But what's really important is when the stress is high and you really need to rely on your broker, then it becomes clear, it becomes obvious who is in the game for making money out of the clients, or who is in the game with the clients. And Admiral is definitely a broker who is in the game with the clients, and this can be perfectly seen in the current market environment. So definitely give Admiral a deeper look. So now we want to talk about trends, progressions, and regressions here, and introduce this to you, in fact, in a very, very simple way. So you will see a chart in a few seconds. The question I want to answer here, in fact, is before we have now an uptrend defined, what's a regression, what's a progression? Why do so many traders look for trends and want to trade them? So you can read this, hear this, read the book on trading. It's always like, I'm following the trend, or you should follow the trend. You should go with the flow. You should try to let winning trades run, which is usually the case. Ride a trend as long as you can until it bends. And then why do you want to do this? I mean, sure, at the end of the day, it comes all down to making money, but here it capitalizes on an identified advantage. This is what it all comes down to. And once you identify the trend, you have already identified the advantage, and you want to position yourself in direction of this identified advantage to increase chances of being profitable in your trading. But what's probably even more interesting is the motivation behind this is to get a better feeling and insight into the thoughts of your opponents in the market and gain an advantage based on that. So what you usually try to do is you try to interpret price action. Let's say if you see a pattern forming like head shoulder formation, or a bull flag, a bear flag, whatever, You try to figure out what market participants are currently doing, respectively what they try to anticipate right now. And so, in fact, when looking at the chart from or in the way which I will present to you here now in a few minutes, you will see that it becomes sometimes really obvious what's going on there, and it becomes also clear that sometimes it makes sense to position yourself in a certain way here. Since price action points exactly to a certain behavior, to a certain action certain market participants are currently taking to position themselves in the market. And that said, professional traders here do not necessarily use their knowledge about price action to trade based on this, so solely trading based on that. So in fact, you could easily say, if I have a sequence of higher highs and higher lows, I trade with the flow or with the trend in this case, and I trade the break to new highs, then long, placing my stop below the last relative low and take it from there. But the thing is that this is not necessarily the case, or this is not a must to trade based on that. But you can also use this knowledge here to get a deeper and even fundamental understanding of the market structure, of what's going on here, and you can identify an advantage which you then try to capitalize and trade based on which you then trade and increase the chances of being profitable within your trading. So now let's start here with two graphics. It's an uptrend and it's a downtrend. So big surprise, an uptrend is defined by a sequence of higher highs and higher lows. And that's probably not such a big surprise. Even here with a downtrend, the same, only on the other side, it's falling highs and falling lows. It's a sequence of falling highs and falling lows. But what's more interesting is here the progression and the regression. So what we consider to be a regression, a progression. First, what we consider a progression here is these are the pieces in direction of the trend, or it's with the current momentum, with the advantage being positioned here. While a regressive move is a move where the extended mode on the upside then corrects some of the further or for some of the progressive move before here, due to the fact that, for example, the longer such a progressive move takes, the more likely it is that the demand, in case of an uptrend, respectively here, the supply will diminish because the risk reward is getting more and more unattractive. That's one of the reasons why you became, or you can also feel this, you know this yourself. When looking at a chart, for example, and you see a parabolic move, well, we could right now look at, for example, the US dollar. 2 weeks ago, there was a massive squeeze on the upside. We're not going into detail now what was the fundamental driver, potential US dollar shortage and liquidity issues coming into play, and banks running into potential liquidity crunch, and thus the ECB had to get money, US dollar demand, huge amounts of US dollar, for example, central bank, ECB or BOJ or Bank of England, and get it from the Fed here. But the longer the move took, the more uncomfortable it was, certainly, to position yourself in direction of the current momentum, which was clearly on the US dollar long side in this case, or when looking at Euro USD, for example, on the downside. So what was the reason for feeling such an uncomfortable thing? So what was the reason for that? Or what was the reason why you had trouble, for example, to jump on this a train when Bitcoin took off in 2017? Why was it so difficult? Because it's very simple to look at the chart and see the market really taking off. And certainly there's then cognitive biases coming into play, respectively psychological aspects like so-called FOMO. It's fear of missing out, for example. But at the end of the day, you also realize the higher the market rises, respectively the lower it drops, the higher the chances that rather sooner than later there will be a corrective move. And so in fact, that's what's happening here. So you have the progression in direction of the current momentum, and then naturally the demand will diminish and we see a corrective move. Once this is once the initial buyers start to enter the market again, probably add to their already existing position, or start to be motivated to buy again into news, whatever it might be. Then you start to see the market gain momentum again in direction of the identified advantage or identified direction in this case, making higher highs, and thus this sequence of higher highs and higher lows, respectively, also vice versa. Here, the downtrend, falling highs and falling lows comes into play. Okay, so that's the basic. I think that's probably nothing new for anyone watching this right now, or if someone's a beginner, she has at least heard once about trends and trading, and then this is in fact something which you should take care of and think about, respectively take into account when taking a position. Now we dig deeper into this topic. So we come now to something we call accumulation, or zones of accumulation and zones of distributions, and what they are. So we know what an uptrend and what a downtrend is. And now the thing is, we run into a problem here, because when looking at the chart now, here at this chart, for example, you can see that this is an uptrend. It's a sequence of higher highs and higher lows. And you can see here, this is a downtrend, falling highs and falling lows. The only problem with that is you look at the chart here, from right to left. So you have history, and you already know to some extent, or you look at it from a pure historic perspective. So you have nothing in regards to informations, what will happen in the future. So you look from right to left. You look back into the past, in fact, and you know what happened. But when you trade, then you're not looking into the past, but you look in fact, a black hole, or you look at a white chart. So there is nothing. There is no higher highs, higher lows, or falling highs and falling lows. There's nothing. It's just white, or it's black. There's nothing else. And so what does this mean when it comes down to get some kind of value out of this information? Well, the thing is that we can say when something is obvious, then there's no money anymore to be made. So what does this mean? Well, remember times during, for example, the dot-com bubble, 2000, or remember the credit crunch, 2008. So we look at these examples also because there's so much information around this right now. You can get everywhere, in books, in the internet, everywhere. So we're not looking at the current situation. So what happened back then? Let's look at the dot-com bubble, or look at Bitcoin. That's probably even a better example, because it's more present. So everyone was talking about this, right? So everyone was wondering, will Bitcoin hit the next milestone, or will it be digital gold, and will this be our next currency, our reserve currency? And everyone started, after it really gained momentum, and we saw this massive squeeze on the upside, up to $20,000. Everyone was talking about this. So you went to the dentist, and you could be sure to listen or find yourself in a conversation which made Bitcoin a topic, or you picked up a newspaper, a magazine, whatever. There was Bitcoin to some extent. Sometimes the headline of the magazine, front page, or it was a story in between with a journalist asking a Bitcoin guru what other altcoins could be out there, which could be interesting and could be the next Bitcoin, where we can get to see such a massive squeeze. So the only thing with this is we are running into something we refer to as sentiment extreme. So if everyone can see what's happening there, the trend won't continue anymore. So it probably, there will be some kind of extreme greed or extreme fear probably. And probably this adds to some extent to this massive squeeze higher, but it's not coming as such a big surprise that this bubble is potentially, especially everyone is, or it feels like as if everyone is talking about it, that the bubble will rather sooner or later pop, in fact. And So this is what's behind zones of accumulation and distribution. So it's, long thing short, it's when something is obvious, then there's no money to be made anymore within the trade. Especially not for those trading huge volumes, institutional players. And these institutional players who have already positioned themselves long time ago, during the time of accumulation in this case, now try to distribute their material to people who are probably seeing a big trend occurring there, to the moms and pops out there who think I need to do something for my, I don't know, for my kids, let's say, or I have to pump up my savings account a little, whatever. So whatever the motivation should be, people who start to recognize a trend, let's say based on a front page of a magazine, of a newspaper, or based on a conversation they have with someone at the dentist, let's say, these people are the ones who are buying at a very high price and with a very, very unattractive risk-reward ratio from those who already positioned themselves long time ago. So this is what this short sentence is all about. When something becomes obvious, there's no money to be made anymore. And also, now let's assume we're one step further here. We are interested in trading. So you're currently listening to this, you're watching this on YouTube, let's say, or you're right now here within the webinar asking questions. I bet that many people of you, everyone, in fact, would consider himself, and I think for good reason, to be advanced when it comes to trading. So we have all already downloaded a demo account, let's say, or minimum. Probably many of us are already trading live. And now the thing is that we already know this trend structure, let's say. And now we assume, well, we just wait for the trend to be confirmed. We probably read a book on this or something like that, and the sequences you have seen there and the examples being shown within a book, within a blog, within or on a website, a research website on trading, whatever. It usually was the case that when you bought the break to a new high, the example shows how you could have profited from it. The only thing is, if you combine this with the when something is obvious idea here, with the you wait for the confirmation of a structure with the market, let's take the uptrend making a new high, we really can't tell since the chart is empty. So there is nothing when it comes to the future. We only know the past, in fact. So we really can't tell whether the market will continue to move in our traded direction, in fact. So we don't have a crystal ball, right? This is the long thing short here. And thus, we don't know if our anticipated so-called risk-reward ratio is really that attractive to justify a trade. So you probably also came across the short version of something like risk reward is important when taking on a trade, and you probably should go for a risk reward of 1 to 2, let's say. So you should have a chance or a potential reward which is minimum as twice as high as your initial risk. It's fine to say that. The only problem with that is you don't know, once you put on the trade, you don't know if the market really has the potential to move that much in your anticipated direction. So to make long things short, when you look at risk reward ratio, it's like it's a pure theoretical number. It's a pure theoretical construct, which in fact, when used that way, does not really add value to your trading at all. Still, it's important. That's something I'd like to bring up right here, because this is not what we want to discuss in detail right now, because we want to talk about accumulation and distribution and how to use this knowledge here in your trading, and then from price action wise perspective. But some of you probably might say now, well, okay, then why do I need risk reward ratio? Well, it avoids that you take trades which are not attractive. So it's like you you guess that the market has the potential based on your research and everything like that. And if you take a trade which has a clear defined risk and you see potential of, let's say, two risks, then it's probably a good trade and you should go for this. There will be some uncertainty connected to it, and you need to remind yourself it's only a theoretical approach, and it long term does not necessarily affect your profitability in trading directly. This is more like the so-called payoff ratio. This is the average gain to the average loss, which results out of your trading results itself. But still, it's a very good way to at least avoid taking trades which are not attractive. So, for example, jump in a trade where the market has moved already very strongly in one direction. Taking Bitcoin as an example, where the market parabolically shot higher, and some of you probably wondered, is it now a good time to buy? Usually the answer to this is definitely no, because now more and more people are watching it. The party is about to end rather sooner than later, which is in itself very unattractive from a risk reward perspective, and then also from a market structure perspective, because once the market shot up quite high, the last relative low level, which potentially acts as a level where you should place your stop, is very, very far away, which means like you're having then an enormous risk compared to a very slow or low chance on the upside, which is resulting in an unattractive risk-reward ratio, which should naturally result in you stepping back from the trade and wait for a better opportunity, let's say. So now let's come back to zones of accumulation and distribution. So what do I mean by that? And here I have a very, very simple chart, in fact. It's, again, theoretical approach, but once you grasp this concept, you will look at every chart from a very certain perspective, in fact. So we have, again, here our sequence of higher highs and higher lows. And now I divide this structure by a green and by a red box here. The green one is the accumulation area, while the red box is obviously the distribution area. And so what you can already see is here, what I meant by once the market breaks to new highs. So this is usually the classic way to look at trading trends. So you look at this here from this perspective, you say higher highs and higher lows, and you're trading the market long in direction of the identified advantage, in direction of this sequence, in this case, the long sequence, by waiting once the market breaks to new highs. And then you place your stop at the last relative low in this case. So here, where my mouse is, I'm not sure whether you can see it, but this is here, the last relative low. So meaning that this green box is in fact your R then, because if you enter the trade here and your stop loss is here, that means that this green box then is 1R. The thing is only that here, entering a position in this area is not optimal. And we look at it now, first of all, from a risk-reward perspective, but we also want to look at it from a deeper perspective here when it comes to bigger market participants. So, and we need to remember this: once something becomes obvious, then rather sooner or later, the trend is about to end probably. So first of all, we look at the risk-reward ratio. So it becomes obvious. The green box here, you can see it. And now we assume that the market really shoots higher here and it goes parabolic. So that means that if you enter the market here with breaking to new highs, this green box is your R. And then here, this is the potential chance. It depends. I mean, the question now is, will the market really move that strong in your direction? This is a very favorable example. Most of the time, again, if the structure is very obvious, if the trend already grew to a certain age, let's say, then it's very unlikely that the market continues to see such a blow off here on the upside. Could happen still, yes, but the risk reward still is unattractive compared to once you say, well, why do I not try to enter trades within this green box, within this accumulation area here? I will show you how we can do this, by the way, how we can achieve this. But now this is obvious, becoming really obvious here, why this is more attractive from a risk reward perspective. We assume that also here we have this huge potential on the upside, which means you have then only this small difference here with placing your stop still at this last relative low, and then the resulting entry price here means that this small what's this bracket? Yes, I think it's a bracket. This smaller bracket here is your R. This is your risk you take. Once it what means nothing more than obviously your risk reward increases because you anticipate a break to higher highs in this case, which means then that you have a higher reward you can expect in relation to your risk being taken, which increases naturally your risk reward. And even if the market does not take on this bullish momentum as illustrated here in this example, still you can see that if the market attacks respectively only sees a short spike above the former highs, for whatever reason, let's assume there's some kind of stop fishing. That's this interruption. I will show you in the next slide. In fact, so even then, you can see that in this example, especially, you've already earned something close to probably even a little more than 1R, and this is something which could result in you formulating a clear rule in your trading, where you say, well, you know what? Once I gained 1R with my trade, I moved the stop to break even. I trail it to break even, which is probably, or which is definitely nothing really nice once you see the market spiking here, faking out, and then you're getting stopped out, break even. But still, at the end of the day, you at least did not lose any money on this trade. So this is also one thing where such an anticipation of a break higher becomes attractive, and there will be times, for sure, once the market is not faking out here, but instead taking on, as in this example, taking on the bullish momentum, which will then naturally result in you seeing a very, very attractive payout for the risk you initially took, in fact. So from a risk-reward perspective, obviously, it should be clear that trading the direct break to new highs is not as attractive as here, once the market once the market still trades within this accumulation area, in fact. So that's one example. Now I'd like to show you also the other example, and there, 1 second here, there we go. And there we want to use this structure again with higher highs and higher lows, and now we like to ask a question here. Let's probably do it that way. So you already see the sequence of higher highs and higher lows, and this is the former high. So now the question is, what do you expect the demand in this sequence in case of a downtrend, the supply to be? Do you think the supply, no, not the supply, the demand being high or being low within this area here? So will it be high demand or will it be low demand? In fact, it's something I don't ask about it because we do not have that much time. But if we had more time, I'd like to ask you now. Please type in your high, respectively your low, in regards to the demand in the chat box. But we will skip this now. I answered this question already. It should certainly be high demand in this area. Why is this the case? Well, for one simple reason, because the sequence of higher highs and higher lows is forthwritten, which means nothing more than this is, especially now, let's come back to the risk-reward perspective. This is a very, probably the last time once you should take the trade, given from this risk-reward perspective I just presented to you here. Okay, so that's really the last time. Now the market is entering this, let's call it the red zone. This is the moment once market participants start, where this is probably this FOMO point. This is the fear of missing out point in the chart, in fact. So this is the last time once someone who's trading the trend here should buy from a risk-reward perspective. Enter to probably an already existing position, respectively enter into the trade. Now, we had also the progressive approach here, the progression traders. These traders are usually those. Oh, let's do it that way. By the way, let's use. Let me just see. Does this work? No, that doesn't work. Let me just see. Does this work? No, that doesn't work too. Oh, okay. Let me just do it then differently. So we use this. Okay. So what is this? It illustrates here the demand being expected at this red line. And we do X's here to show, okay, there will be high demand, naturally high demand, which means it's not only that the trend trader will enter here, but also progressive traders, progression traders have to buy here from a risk reward perspective. Remember, let's come back here. So the progression traders are those who try to trade this part of the chart. So they do not try to capitalize on the structure of higher highs and higher lows, but they only trade during this, in this case, green line or green part of the chart. So now let's look at this also from a risk reward perspective. If you trade this part of the chart, you know that once the market makes new highs, there's probably a reduced chance of the market continuing with its bullish momentum in this case, or the bearish momentum in case of a downtrend, which means they probably are more keen to say, I try to buy here in this area, somewhere here, since then I have still, if this sequence continues, I have enough, let's call it meat on the upside, I can try to capitalize on. Okay, so that means that usually this is the moment once all these progressive traders also have to come into play here. It's not only that trend traders have to buy here because of this is the last chance from a risk reward perspective to position yourself into a trend, but also the progression traders, same thing, same logic, same thinking behind this. It's a complete different trading approach, but still this is the last time from a risk reward perspective, they should try to position themselves. So the same is also true for the regression traders. The regression traders are those who try to capitalize here on this corrective move. And naturally, here, the red line is the point where these market participants who have a deep market understanding, the market participants who understand the structure, the market structure here, where these market participants also have to say, okay, now the sequence continues and the regression is definitely over. So this is the moment, the last point of exit, in fact, once the sequence is forthwritten here. So this is the last point. I have to be stopped out of my regression trade in this case. So which means that now coming lower here, the lower we get, the lower the necessity, respectively, the willingness to buy. Which means naturally in such a sequence here in this region, let me just probably point it that way. In this region, you naturally have the lowest demand, which increases naturally the moment you come closer and closer to this point where this sequence of higher highs and higher lows, this long sequence is forthwritten in effect, right? So, which means here, the moment you see this high demand coming into play, now let's put yourself in a position of a big player, an institutional player, let's say also a fund, for example, someone who has to build a portfolio. He trades for bigger clients. And now assume this guy has, or this portfolio manager has 1 billion asset under management. And now he gets an order. Let's look at this chart here. Let's say it's an Apple. It's an Apple share, so a stock Apple. So and now assume that he has now the order to buy, let's say 100 million shares. I just said that we have 1 billion asset under management. Let's assume this is just correct. So you have to buy, or the value of the position should be 100 million. Even this shouldn't be such a big issue in such a liquid stock, but let's assume that this is, we don't discuss this any further here. For illustration purposes, that might be okay. So now assume that this market participant, this player, has to position himself into the trend for his clients. And now this portfolio manager sitting in front of a chart and seeing the sequence of higher highs and higher lows having developed, and knowing that the highest demand will naturally be here in the region of the former highs after this corrective move. So what do you expect him to do? Do you really expect him to buy the whole position once the market breaks to new highs? I don't think so. So we assume that he knows that the market will continue with its structure on the upside. Certainly, this could even add further fuel on the downside if the market fails to confirm the structure. But what do you think? What is the most likely thing he will do? He will start to accumulate the position. Step by step by step, he scales himself into the trade, and he tries to do so before the market breaks to new highs. That means he will be a buyer here within this region. So here with the 3 axis, 2 axis, respectively, the 1 axis here, and yeah, probably start to put a stop somewhere in this region. But it's the idea behind this which is more important. So what you try to do, or what you're getting paid for, is that you anticipate the break higher, you take a risk that the market does not do this, but you get a higher payout once the market breaks to new highs. And this is exactly what's happening here in this area. So now, I just wondered, to be honest, if it makes sense now to look at the interrupter and talk about stop fishing. I'm not really sure if this makes so much sense. I think it's probably more interesting to look at how to reduce mistrades, in fact. So the interrupter, we try to avoid them. So I introduce them, but only in a very short way here. So the interrupter is happening once the market has seen such a sequence of higher highs and higher lows, and then you see the market coming from these highs lower, and not only testing the region of the former relative low, but instead of that, spiking slightly below that and then taking off from there again. You probably have seen this plenty of times in your trading, that the market sometimes you have the feeling he's really looking for these regions here, seeing the market, testing them, spiking slightly above or below, and then taking off from there. And this is exactly where stop fishing comes into play, respectively, where it's necessary to understand that the trend is not necessarily broken once this happens, but it's only interrupted for a short period of time. It can be a first signal that the momentum starts to diminish here, and you should be careful when it comes to the overall, in this case, long sequence, but still the trend is given. And if the market only spikes here lower and then taking off from there, the sequence is still given, which is very, very, you probably are very unhappy to see that, because now you probably positioned yourself in such a regressive move here in the so-called accumulation area, and only to see the market spiking out your stop, because you probably positioned yourself somewhere here within this region with a stop at this red dotted line, seeing the market taking out your stop and then taking off from there. So your main intention was right, but you're still not positioned since your stop was fished here. And now we want to introduce to you, or I'd like to introduce to you, an idea how to effectively reduce this. And therefore, we'll look at this example here. So we know that every time frame, 5-minute, 50-minute, hourly charts, daily chart, H4 daily charts, show the same chart, but with a different zoom effect. So let's look at an hourly chart here, and now let's zoom into the hourly chart, and here, look at the 5-minute time frame. You will see that this sequence here, this push higher on an hourly chart, is in fact a sequence of higher highs and higher lows on a 5-minute time frame or a 50-minute time frame. And why is this of importance? Well, it gives us a very interesting idea regarding our introduced accumulation distribution areas, because now you can use those 2 boxes, the red and the green one here, put them above your chart. You have a sequence of higher highs and higher lows, and you know, distribution area, okay, this is where I don't want to position myself. Here you have the accumulation area. You try to position yourself here. So now you use this knowledge and you apply it here to the 5-minute chart, and you put this accumulation distribution area now on this chart. And how could this work in the real world? Before we introduce this to the real world, now we have, first of all, create such a picture. So if you take something out of today's webinar, then you should probably screenshot this. this is probably getting already lots of work done for you, because now you can look at which time frame am I trading in and who is my direct dominator. So who do I want to position myself with, respectively, who's probably also, this is the next step then, who's the dominator of my dominator, in fact. And so let's assume you're trading a 5-minute or a 50-minute chart, in fact. So this is probably true for most of day traders. Then your direct dominator is the hourly chart, respectively the 4-hour chart for FX traders, and the dominator of your dominator is the daily chart. That's probably the most common area here, in fact. So if you're trading 5-minute to 50-minute, then it should you should look at the hourly chart and where do we stand in the hourly chart, respectively the daily chart, to see when you're trading the hourly chart who's the dominator and what is the dominator currently doing. So now the main question was, nevertheless, it wasn't who is my dominator, but it was like, how can I effectively reduce mistrades? And now I'd like to introduce to you a concept which is, in fact, I think very simple. Still, it is important to sit down after this webinar probably and think about this again, and then apply this, get a feeling, get a grasp the concept behind this. So what we now try is we try to pro-cyclical position ourselves and optimize the entry of our trade, in fact. And therefore, first of all, we look at a sequence of higher highs and higher lows. In this case, we take a 4-hour chart in which you recognize a regression. One thing, very important, 4-hour means here that we're then obviously looking at a 5, probably even a 50-minute chart, okay? So this is what we do. So we see the sequence on the time frame above our traded time frame, which is in this case the 4-hour chart, and we are trading a 50-minute chart in this case, okay? So, oh, by the way, that was, oh yeah, okay, fine. So now, our traded time frame, in our traded time frame, we wait for the break of the downward sequence to happen. It's R1, respectively move back above the purple dotted line. I trade the pullback to a former high before P1. Simple, right? No. So I have a picture for that. So what do we have here? We have the sequence on H4, higher highs and higher lows. We know that here, this green box, it's the last relative high and the last relative low. This is our accumulation area. And now what we see here is the market in a regression, okay? We do not know how long this regression will take. This is something which should become become obvious already, because the thing is that we do not know what will happen in the future. We only know the past since we're looking at chart from right to left in this case. So what we have then here is this regressive move, and what we do now, or what we wait for, is that this sequence of falling highs and falling lows, which developed on a M15 chart here. Once this is broken and the market clearly shows that there's no higher demand than supply, respectively in a downward sequence you have higher supply than demand, but here it's the uptrend we try to capitalize on. So we have now a sequence of falling highs and falling lows. This is the red line here. So falling highs and falling lows. This is R1, okay? This is the last relative high, which means that everything happening below that level can be considered bearish, because as long as we do not break significantly as sustainably above this R1 here, the sequence of falling highs and falling lows is still given, okay? So now we look at here, we look at this green part of the chart. So here, now the market attacks this level, fails at first, but then takes this level out, pushes to P1 in this case, here, the green P1, and then we say a pullback here to this former high in this case, we plan to position ourselves long with, because the market now here in green starts to develop a long sequence in green in our time frame with the overall advantage which is given in our direct dominating time frame, where we still have the sequence of higher highs and higher lows, okay? So here we have a long sequence, and what we only try to achieve is to position ourselves with this overall long advantage into this accumulation area. This is what we want to achieve here. And this is exactly what's happening here. So the market is seeing a regressive move, which is natural in trending structure. But what we want to see is that this regressive move comes to an end, which can then be optimized in regards to the entry in our traded time frame and M15. This is happening here. R1 is broken. So we start to see a sequence of higher highs and higher lows, and then we trade the pullback here back to the former R1. Here you can see this with this purple line, while we place our stop here below this last relative low. This is a first level. A second one could be that you say, I try to position myself here in this sequence and place my stop here. So that would naturally result in a wider stop, reduced risk, and everything. So, but this is how you try to optimize your trading and reduce mistrades in this case in your trading. That's in fact what it's all about, in fact. And yeah, so we come to the summary of all this. So thinking in terms of structure, price action does not necessarily mean that you trade based on this principle, but based on a deep understanding of the market structure here, for example, is that beside the chance of going long and short, you have the chance to influence your position size. Or to put it differently, that was what I said at the beginning. If you grasp this concept and you get this deeper understanding of the market structure, and your system might be based on, let's say, exponential moving averages, whatever, is, let's say, about to enter a long position, but you recognize that, let's say, you enter the trade on M5, M15, for example, but the dominating time frame, H1 or H4, is about to enter the distribution zone. It means that you could, for example, actively reduce your position size and say, yes, the long signal is generated, but my target is to optimize my trading, to smooth my equity curve, and thus I take out the risk of the position I now plan to enter based on the market structure I look at here, and given the fact that the risk reward for long engagements seems to be more unattractive in my direct dominating time frame. Yeah, and that's it. So it's in fact a complex topic. I really probably it's a great time now to think about this before the weekend. Probably also use the time next week. It's the Easter weekend, a prolonged weekend, to probably dig deeper into this topic. But before you do that, don't forget to join us next Monday with Paul here to introduce to you a simple trading plan using the RSI, Relative Strength Index. So he will introduce to you what is the RSI. He will show you, explain to you how traders use it and how we'll use it to create a trading plan, in fact. 2 p.m. London. On Monday, it's 1 p.m. GMT right now, so it's BST. It's summertime. 6th of April, check your inbox for the webinar link. If you now listen here to the webinar live, then you already registered for the webinar, and you will get a link directly to your inbox on Monday. If not, if you watch this on YouTube, then go to the website, admiralmarkets.com. There, the education and the webinars tab, and there you have the chance to register for this Trading Spotlight webinar series. Here's the website, admiralmarkets.com. Here are the contact details. And yeah, to here at the end, I have to show you the risk disclaimer. That's it from my end. So thanks a lot for joining today. I hope you enjoyed the topic. If not, please feel free to ask your questions in the Trader Spotlight webinars community. It's based on our webinar series, or right below the YouTube video. The recording will be available here very soon. And that's it from my end. So all the best. Happy trading. Watch your stops. Stay safe, and talk to you soon. See you, and bye-bye.